Welcome to another episode of Lunch with the Shark. Join us as we dive deep into discussions about business, accounting, and finance to help you build a business that thrives. Now sit back and have a bite with your host, the Shark CFO, Vidal Espinosa.
Hello, good afternoon. Welcome to a new edition of Lunch with the Shark. I am your host, Vidal, the Shark CFO Espinosa, and damn, this place is cold. I am freezing my butt off. My hands are cold, my feet are cold, like it's super cold. We are, it shows and it feels that we are right in front of the ocean. I had a couple of questions like, oh, show us how it looks. We'll do a live tomorrow. On the view that we have here in our new place for a couple of weeks, right? So different setting, different atmosphere, different everything. So it's great to finalize this interesting and peculiar 2020, if I may say so, right? So today's topic, we are continuing in our week's topic, which is tax planning. Okay, and a lot of us and a lot of business owners, they just focus on income tax, business income tax. But there's a lot of taxes and fees that as business owners, we are not aware of. I'm going to give you a couple of quick examples of those. And for instance, in California, we have a annual or biannual statement of information. There's a fee associated with it. There's also tangible property tax for the county of San Diego. Yes, you have to pay a small fee, small taxes on your assets. And it's everything that the business owns, from its small equipment all the way to inventory, vehicles, on top of property tax that you pay if you own property. Yes, that's another tax that you might not have known. Business license. You have to pay a business license tax in the city, county, the city of San Diego and other cities, city of Chula Vista. You have to pay a tax, a business license tax, business BTC, business tax certificate. That's another fee or license fee that you have to pay. So it's very interesting because a lot of us, we just focus on income tax. And what we're not aware of is that there's multiple taxes that we have to account for, we have to project for, and we have to budget for. So there are tons of different taxes you have to pay when you're in business. A lot of this type of business owners don't know what type of taxes you need to pay. So let's dive right into this type of taxes. And today we're going to go over 5 different type of taxes. Okay, 5. There's more, but we'll go over the 5 most important ones. Okay. Let's say, for example, your business is booming and you want to hire 2 employees. Shouldn't you first consider tax implications and how much is it going to cost us? As small business owners, regardless of the business type, yes, it's for every type of businesses. It's not only like for the healthcare or for service providers that are attorneys or accountants or financial planners. No, it's for every type of businesses. So the first one, and the one that we all know, income tax. All business structures except partnerships will file a yearly income tax return. Partnerships do not pay income tax, but they do file an information return. Okay? Partnerships are the only structure that does not pay income tax. And listen, structure, because I'm going to get comments. It's like, what about S corporations? S corporations are not a business structure. Okay? They're a way of paying taxes. And that tax return, it's also informative. And at the end of the day, the owners pay, the shareholders pay the tax. Okay? Even though most business structures file a yearly income tax return, not all businesses use the same form when filing. The form you file depends on your business structure. If you're seeing here, there's a common denominator between what I said yesterday, the day before yesterday, and today. Every tax strategy and tax planning begins with, guess what? Your business structure. So if you want to have a good solid foundation, you're going to get a good solid advisor to create your business structure. Your business structure, as I said, it's not just your freaking birth certificate that LegalZoom or any of those services are going to provide you for $99, or for this Black Friday and Cyber Monday, we're going to do it for $7. And then after that, what's next? Be very cautious, be very careful, okay? The form you file depends on your business structure, which is officially established during your business setup phase. Partnerships and corporations that have elected to be taxed as an S corporation, they are considered a pass-through entity, meaning earnings and deductions pass through, okay, the business entity, and then each partner or shareholder, in the case of an S corporation, they receive a form called K1, which is then entered on each taxpayer's income tax. Wow, this is so difficult, right? Well, it's not. It is not. Sole proprietors and single members LLC owners pay income tax based on the net income of their business. To determine net income, you need to complete Schedule C as part of your personal tax return. The net income from your Schedule C is added to other sources of income to determine your total tax. Wow, that's super, super complicated. It is not. As you see, each business structure, because sole proprietors are a business structure, they're on their own, right? But they're a business structure. They have to present, or they have different obligations when it comes to income tax. Okay? Second type of taxes, estimated taxes. Guess what? During the first year, you don't have that obligation to present estimated taxes. Okay? Only if you had paid taxes the prior year superior to $1,000, you are required to present estimated taxes on a quarterly basis. Damn, that sounds like a riddle. Well, it's not, if you know what you're doing. And the only thing you need to know what to do is to grow your business, generate revenue, so somebody expert can help you with this problem, paying your estimated taxes. When our estimated taxes are due, they're due every 3 months, okay? And it's 1/4 of 95% of your last year's tax liability. Damn, that's a very complex formula. If you don't have taxes withheld each paycheck or each payment from your clients, or if you don't have enough taxes withheld, you may need to pay estimated taxes. Estimated taxes are paid on regular installments, usually 4 equal payments through the year. Okay, so if you are a sole proprietor, you're going to use Form 1040 ES, and this is for federal taxes purposes. Okay, we are assuming that there's no nor state taxes. Okay, but if you have state taxes, you also have to pay estimated taxes because most likely they follow the same guidelines as the federal government. Okay, so you need to divide, or you need to multiply your total tax liability for the previous year by 95%. Divide that by 4 and pay or make a payment, okay, every 3 months to the IRS, and here in California to the Franchise Tax Board, okay? If you are a corporation or you're a sole proprietor, or regardless, if you're not a sole proprietor, but you have a pass-through entity, K1 partnership, K1 small business, you need to make payments every 3 months by the 4th month on the 15th. April, July, October, January. That's simple. And if you do not do that, the IRS and the state of California, since we're in California, will impose a penalty for underpaying your tax liability. Yes, they like to charge penalties for everything, and penalties carry also interest. Okay, so be careful, because according to the Franchise Tax Board representative or agent, the state of California borrows money for the taxes that you don't pay, so you have to pay them interest on the money that they borrow on your behalf. So basically, they're financing you, and since they're financing you, you have to pay financing charges in the form of interest on top of the penalties for not complying with the law. And not knowing the law does not exempt you from utilizing it or implementing it or paying attention to the law. Number 3, self-employment taxes. What is that? Why should I pay self-employment taxes? Self-employment taxes are Social Security and Medicare combined. Listen, when you have a job, when you used to have a job, if you were an employee in one point of your life, now that you're self-employed or you have a business, you get a salary. And on that salary, they would withhold taxes from that salary, right? And those taxes, for federal purposes, were your income tax, were your FICA, Social Security, Medicare, okay? Well, now that you're self-employed or you have a partnership, okay, you have to pay self-employment taxes. You have to contribute to your Social Security and Medicare. Generally, as I said, if you work for yourself, you're responsible for your self-employment taxes. When you pay self-employment taxes, you contribute to certain benefits to which you're entitled, such as Medicare, retirement, disability, and survivor benefits. First, see if you're required to pay self-employment taxes, and when you pay self-employment taxes, you might be required to file Form SE for federal purposes. Listen, I hate giving you names or numbers of forms because it's my belief that you should not be doing your personal taxes. It's my belief that in order for you to generate a true mindset as a business owner, you should hire experts. You should have experts support you through all the process of your business. I understand that at the beginning, it's very difficult to make ends meet when it comes to being a self-employed, having your own personal business, being a business owner, and getting as much as income for your life. But if you continue with that mindset, you're never going to grow. You're never going to get out of that hole. Okay? So the sooner the better when it comes to this mind shift. The sooner the better when it comes to this mindset of a true business owner. And you leave the business operator, you leave the, oh, I am a freelancer. The sooner the better. So part of the business tax strategy is saving on self-employment taxes, saving on Social Security and Medicare. It's better to set up a 401k or a Roth IRA that you can self-direct, self-manage that retirement. Think about that. Oh, that sounds very scary. That sounds like a grown-up conversation. Well, we are grown-ups, and it's not scary if you just know the basics of those terms. That's it. That's all you need to know. You need to know that if you continue the way you are, if you continue not budgeting accordingly and correctly for advisors, you're going to end up paying self-employment taxes. And you know what's the percentage on self-employment tax? And this is just on top of your income tax. 15.3% of your profits. Guess what? That's a shitload of money. It could be a shitload of money. Employment taxes. That's the number 4. If you're a business owner with employees, yes, with employees, you'll probably pay employment taxes. Employment taxes fall into 3 categories. And this is just for federal purposes, okay? Social Security and Medicare, yes, you are going to be paying self-employment taxes for your employees, federal income tax withholdings, and federal unemployment tax, commonly known as FUTA. You have to add and you have to consider state employment taxes. Yes. But guess what? The employment taxes that you pay for your employees, not what you withhold from your employees, it's deductible. What? Yes. So listen, you pay 15.3% in self-employment taxes when it comes to Social Security and Medicare. Okay? Now, when you have employees, they pay 50% of that, and you pay 50% of that. That 50% of the 15.3%, it's tax deductible. It's an expense that you can deduct. It's an expense that you can take off your gross revenue. Interesting. Same as the FUTA tax and any expense, when it comes to state taxes that you pay not on behalf of your employee, but for your employee. Not what you withhold, because whatever you withhold belongs to the employee, does not belong to you. Okay? It's totally different. It's totally different. Excess tax. Number 5, what the hell? It's excess tax, you will say. Well, the federal government, they have to get money from anywhere, right? They have a shitload of things to pay for on our behalf, right? So businesses that produce or sell certain items, tobacco, now in the state of California, cannabis, alcohol all over the country. Similar businesses that use certain equipment, facilities, or commodities, or collect payments for specific services may be responsible for excess tax. Do you know that? Wow. I'm going to give you a couple other taxes that you might not be aware of that you have to pay. Sales tax. Sales tax, it's a state tax that it's collected by the end consumer, okay? Sales tax on products and services sold on certain items. Businesses don't pay directly the sales tax on product and services they sell. But if your business operates in a state that has state income tax, you must set up a system to collect sales tax from your customers and report it and pay it to the state. Only the end consumer in some states, if not all, pay sales tax. Okay? For instance, let's say that I am a car dealership. When I buy the cars, either from the auction or from the auto manufacturer, I don't pay sales tax. But when I sell that car, I actually collect the sales tax from the end consumer, from the final purchaser, which would be you, right? So I collect on behalf of the state a sales tax. And then either on a monthly, quarterly, biannually, or annually basis, I have to report all my sales and pay the sales tax. Simple as that. Property taxes. Even if you're not in business, as a homeowner, you have to pay property tax to your local authorities. Wow, that's a lot of taxes. So, are you ready to calculate or determine all the taxes that you have to pay? I don't think so. I don't think so. There's regulations, there's circulars from the IRS, there's circulars from the Franchise Tax Board in California telling you, oh, you know what, the law says this, but you actually have to implement this. With the new CARES Act that came out back on March or April, there's new things. Do you know that if you applied for the payroll protection program, which is a loan that gave you 2.5 months or 2.5 payrolls to cover while we were closed for the first couple of 3-4 months. If you get that loan forgiven, your expenses associated with the utilization of that loan will not become deductible. Oh, but it's a necessary and ordinary expense, and it goes against what the tax code says. Yes, but since you're getting a benefit of grant of a money, you cannot double dip. That's what the Department of Treasury through the IRS is saying. You cannot double dip. We're getting free money and you're getting a tax deduction. It doesn't work like that. It doesn't work like that. And I've had several customers come to us and say, oh, that's not possible. That's not true. It cannot be. Well, just think about that. You got $10,000, right? And the government's going to say, okay, those $10,000, you're not going to have to repay them. And since they are a loan, it's not considered income. And on top of that, since you're not going to repay them, we're not going to consider it as as we are forgiving the debt. We're just giving you free money. How are you going to also deduct from your total revenue another $10,000? That's double dipping. So you're going to have to eliminate those $10,000 expenses. Therefore, your bottom line, as it is right now, it's going to increase. So if you have a $10,000 profit, your profit is going to turn into $20,000 profit for tax purposes. That's a little bit complex. And if you're not projecting for that, that's going to be an impact in your income tax for your corporation, for your business, even if you're a sole proprietor and you have employees. So you need to plan accordingly. This year, it's all about planning. And moving forward, it's all about planning because I'm pretty sure that the tax code is going to be reformed with the new administration that is coming in. So reach out to your advisor, reach out to your tax expert to help you maximize on those issues. Okay, so I'm gonna ask you to follow us today on Twitter. I think we do use Twitter. I think Jesus helps us with Twitter and posts a couple of things there. If not, follow us on LinkedIn. Also follow us on Facebook. Look for our Invictus Advisors USA. And we have special information on each of our social media. And today we're going to end up our show with a quote from Arthur Godfrey. And he said, I am proud to be paying taxes in the United States. The only thing is I could be just as proud for half of the money. Well, I guess you have not found an advisor like the one that Donald Trump has, Warren Buffett has, Bill Gates has. Do you want me to continue with the list of the top 500 Fortune companies and the top 500 Fortune wealthiest individuals in the world? I guess that I actually bet you that you're paying more taxes percentage-wise than they are percentage-wise. Not amount, percentage-wise. See you tomorrow on another episode of Lunch with the Shark. Bon appetit. Ciao.
Thank you for listening to Lunch with the Shark. If you would like to set up a consultation with the Shark CFO, Vidal Espinosa, visit his website www.invictus-advisors.com and don't forget to subscribe on Facebook, Instagram, YouTube, Twitter, and LinkedIn.